Imagine this. You wake up, check the news, and bam! A global tech powerhouse, a real titan, has just announced it's handing back this massive chunk of change to its owners.
Yeah, moves so big it sends waves through the stock market instantly.
Exactly. And everyone's talking about it, right? From the seasoned pros to people just curious about finance. That's exactly what happened on September 12, 2025.
Mm-hmm.
So today, we're doing a deep dive into Infosys' absolutely enormous share buyback plan. We're talking Rs 18,000 crore. That's staggering.
It really is.
Our mission. Let's unpack what this really means, why they did it now, and what it tells us about the state of tech and finance today.
And it's more than just a big number, isn't it? It's, a fascinating look at capital allocation strategy. It says a lot about their financial health.
Right.
And it's like a real-time case study, really, in how these big companies navigate growth versus rewarding the people who own the company, the shareholders.
We'll get into all the layers,
Yeah.
the market mechanics, the wider picture for Indian IT. Should be interesting.
Definitely, from the nitty-gritty to the broader implications.
So if you've ever wondered how these giant financial moves actually work or, what they're really signaling, well, you're in the right place for an illuminating deep dive. Okay, let's get straight into it then. September 11th, 2025. Infosys, the IT giant based out in Bengaluru, they announced this huge thing, their biggest ever share buyback, Rs 18,000 crore.
Just an enormous figure.
And the reaction. The very next day, September 12th, boom, the shares jumped. Over 2% in early trading on the Bombay Stock Exchange.
Yeah, they hit Rs 1,544.65, up from just over Rs 1,500 the day before. The market clearly liked it.
No kidding. A clear thumbs up from investors.
What's really striking here is the scale, and I think the strategy behind it. This isn't just, some routine adjustment. It's their fifth buyback, sure, but it absolutely dwarfs the previous ones. They're planning to buy back up to 10 crore shares. That's 100 million shares for our listeners at Rs 1,800 each.
And that price, Rs 1,800, that was key, wasn't it?
Oh, absolutely crucial. It offered a pretty juicy 19% premium over the closing price from September 11th. That's a significant incentive.
So it's not just shuffling money around, it's a statement.
Definitely a statement. Confidence in their own value, confidence in the future, you could say.
Okay, for folks maybe newer to this, what exactly is a share buyback? It sounds simple, buy back shares, but there's more to it, right?
There is. Basically, the company uses its cash to buy its own stock off the open market.
Okay.
The main effect. It reduces the number of shares out there, fewer shares floating around.
Like slicing a pizza into fewer, bigger slices.
That's a great analogy, actually.
Yeah.
Fewer slices, so each remaining slice represents a bigger piece of the pie, the company's earnings and assets. So it tends to boost things like earnings per share, which investors like to see. And it's a direct way for the company to say, hey, we're healthy, we have extra cash, and we're returning it to you, the owners.
Makes sense. But the actual process, I imagine, is not just clicking buy on a trading app. There's paperwork, approvals.
Oh, absolutely. There's a whole process. This one is using what's called a tender offer.
Tender offer.
Yeah, so eligible shareholders can choose to tender or offer their shares back to the company at that fixed premium price, the Rs 1,800.
Gotcha.
But first, it needs approvals. A special resolution from shareholders, they vote on it via postal ballot. And, critically, it needs the green light from regulators like SEBI, the Securities and Exchange Board of India.
The market watchdog.
Exactly. And they build in protections, too. At least 15% of the offer has to be reserved for small shareholders.
Oh, that's interesting. Why?
To ensure fairness, really. So everyday investors, folks holding less than Rs 2 lakh worth of stock, get a decent shot at selling their shares at that premium price. It's not just for the big players.
That seems important. So once all that's cleared.
Then it can kick off pretty quickly. The whole thing might wrap up in just a few months.
Okay. Now, to really get why this Rs 18,000 crore move is such a big deal, we kind of need to understand Infosys itself. This company's journey. It's pretty incredible.
It really is something.
Started back in 1981. In Pune, right? 7 engineers.
Yeah.
And the initial investment, get this, Rs 10,000.
Incredible, isn't it? Talk about humble beginnings. A tiny software exporter.
And now?
Now, one of India's absolute crown jewels in IT. They serve over 3,000 clients globally. We're talking giants like Boeing, Goldman Sachs, massive names.
Wow.
They're headquartered in Bengaluru, employ over 300,000 people around the world. And revenues, over Rs 1.5 lakh crore in the last fiscal year.
That's just phenomenal growth. Foundational for India's tech scene, like you said.
Absolutely.
But it hasn't always been smooth sailing, has it? They've hit bumps. I remember the whistleblower thing in 2014,
Yeah.
the pandemic disruption in 2020.
True. They've definitely weathered storms. But their resilience is pretty remarkable.
What's the key to that, do you think?
I'd say a consistent focus on what matters.
Yeah.
Digital transformation, cloud computing, and now, they're making a serious push into AI. They adapt.
So they're not just lucky, it's strategy.
It's strategy, it's adaptation, it's building a strong foundation. They've shown they can evolve.
So financially speaking, where do they stand right now? Are they still, sitting pretty, as they say?
They are, very much so. First quarter of this fiscal year ending June 30th, revenues were up 7.5% year-on-year, around Rs 42,000 crore.
Solid.
Net profit strong too, around Rs 6,400 crore. And the cash pile, that's key here, over Rs 40,000 crore.
40,000 crore in cash.
Yeah. So under CEO Salil Parekh, who's been there since 2018, they've shown really efficient operations, prudent financial management.
Unlike some tech firms maybe burning cash on wild bets.
Exactly. Infosys has actually returned a lot of cash to shareholders since 2017, over Rs at 57,000 crore through buybacks and dividends. That builds a reputation for reliability, for, being sensible with money.
Okay, which brings us back to the why now question. Given the market's been a bit choppy for IT stocks, why pull the trigger on this record buyback right now?
That is the $1 million, or rather 18,000 crore rupee question, isn't it? And it's a confluence of factors, really. Firstly, the Indian IT sector has faced headwinds. Global slowdowns, rising interest rates in the U.S., recession fears in the U.S. and Europe. These are big markets for them.
Right. IT exports are huge for India.
Over 50% of the industry's revenue, so that pressure is real. Infosys' own stock was down about 22% over the past year. Its price-to-earnings ratio was around 25.
Which is still decent, but maybe not where they want it.
It suggests a premium valuation, but yeah, the downward trend was there. So doing something to support the share price makes sense in that context.
And then there's the elephant in the room.
AI, massive elephant, exactly. The whole landscape is shifting. Clients aren't just after basic outsourcing anymore.
They want the fancy AI stuff.
They want AI-driven solutions. For cost-cutting, sure, but also for actual innovation. Infosys knows this. They're pushing things like their Topaz AI platform, partnering with NVIDIA.
But their R&D spend.
That's the interesting contrast. It's still relatively modest, under 1% of revenue. Compare that to, say, Microsoft or other U.S. tech giants investing 10, maybe 15% in R&D.
So that begs the question. They have Rs 40,000 crore in cash. AI is critical. Why not pour that 18,000 crore into R&D? Or maybe buy some cutting-edge AI company.
And that's the core of the capital allocation debate right there. It's a strategic choice.
So why the buyback then? What's the thinking?
Well, look, it's a classic financial play. Interest rates are still relatively high. Maybe finding truly compelling large-scale investments right now is tricky.
Okay.
So returning cash to shareholders, that's often a very sound financial move. It directly boosts earnings per share because, remember, fewer shares. Analysts think maybe a 2-3% EPS lift from this.
Which looks good to the market.
It does. And for shareholders, it can be tax efficient too, especially in India with the capital gains tax structure. It's a way to deliver value directly and arguably safely in a somewhat uncertain environment.
Right. And as you mentioned, this isn't exactly new territory for Infosys. This is buyback number 5.
Number 5, yes. They did a big one, Rs 13,000 crore back in 2017. Another Rs 13,000 crore in 2020, right in the thick of the pandemic uncertainty.
I remember that.
Then smaller ones, well, relatively smaller, Rs 9,200 crore in 2021 and Rs 9,300 crore in 2022-23.
So there's a definite pattern here.
There is. And each time, they offered a nice premium, anywhere from 18 to 30%. The market generally reacted well each time.
So this latest one, while huge in absolute terms, fits the playbook.
It does. It covers a smaller percentage of their total equity this time, about 2.41%, but the sheer size, the Rs 18,000 crore, reflects how much the company has grown and signals, again, that confidence and stability. It seems to be a trusted tool in their financial toolkit.
Okay. So the market reaction we talked about, shares up, general positivity, the financial world seemed to largely embrace this.
Oh, definitely. Brokerages were quick to jump in with positive notes. You had CLSA, Nomura hiking their target prices up near Rs 100, 180. They called it value accretive, highlighting financial stability.
Good buzzwords for investors.
Exactly. Even Morgan Stanley, who were kind of neutral overall, noted it gave sentiment a real lift. And places like Equity Master called it a sweet deal, pointing to that strong balance sheet, debt-free, and those impressive 20% operating margins.
Sounds like a chorus of approval.
Mostly, yes. On platforms like X, you saw a lot of chatter, too. Some witty comments, like one user saying, "Buyback, corporate self-love at its finest." Captures that mix of approval and maybe a hint of questioning the motive.
Right, because not everyone was cheering without question. There were those other voices, weren't there? Particularly online, wondering if this was maybe a missed opportunity.
And that's where the really interesting debate picks in, I think. The critics, or maybe just the questioners, are saying, okay, 18,000 crore is great for shareholders now, but was this the moment for Infosys to make a truly bold bet on the future?
Like what? What could they have done?
Imagine, say, huge investments in building world-class AI research labs, or maybe a major push into quantum computing, or perhaps acquiring a really innovative, disruptive tech startup.
Something transformative.
Exactly. The concern some people raise is whether Indian IT firms, even giants like Infosys, risk staying primarily service providers if their R&D spending doesn't keep pace with global tech leaders who are becoming product pioneers.
So it boils down to that tension. Short-term rewards for shareholders versus those potentially game-changing long-term moonshot investments.
That's the heart of it. It's a fundamental strategic choice. Now, Infosys would argue they are innovating, right? They point to their innovation network acquisitions like Panaya.
Sure.
But when you put their R&D percentage against, say, an Oracle pouring billions into AI infrastructure, it does make you think. This buyback highlights that classic corporate dilemma. Balance the present with the future. Give back cash now or invest heavily in something speculative but potentially revolutionary.
It feels like they chose the safer, more immediate path here.
It certainly looks that way. Prudent, financially sound, rewards loyalty. But perhaps not the most audacious move imaginable at this particular tech juncture.
So let's bring it down to the individual level. If you're listening and you hold Infosys shares, or maybe you're thinking about it or just watching the tech space, what's the takeaway for you?
Okay, well, for existing shareholders, especially if you were maybe thinking of selling anyway or feeling a bit cautious about near-term growth, this buyback is pretty straightforward. It's an offer to sell some shares at a nice premium, an attractive exit, potentially.
And if you're a long-term holder,
then it's arguably a strong signal of confidence from the company itself. Plus, mechanically, fewer shares usually mean higher earnings per share down the line. Add in their dividend yield, which is around 2.5%. The total return could look quite appealing over time.
What about that valuation? You mentioned the PE ratio earlier. Is it still a good buy?
Look, at 25 times forward earnings, it's not objectively cheap, but is it justified? Many would say yes, given their guidance for 10-12% revenue growth next fiscal year, their stability, their market position. And you've got potential tailwinds too, maybe U.S.-India trade deals, GST rate cuts, things that could help the whole sector.
All right. And speaking of the sector, what about the ripple effect? Does Infosys doing this push other Indian IT giants like TCS or Wipro to do the same?
It could very well. The Nifty IT index, the basket of IT stocks, has been volatile, down about 10% this year so far. Issues like those U.S. outsourcing tax worries, slower deal wins, they've had an impact.
But you mentioned green shoots.
Yeah, recent results have shown some positive signs. Infosys' Q1 actually beat expectations. Their deal bookings were strong, $4.1 billion, especially in banking, finance, and manufacturing. So seeing Infosys act decisively, especially when peers like TCS also did a big buyback last year, or is 18,000 crore too, actually, and Wipro's also sitting on cash, it could definitely encourage similar moves.
They're all facing similar pressures, similar opportunities.
Exactly. And remember how big the sector is for India? Market cap over Rs 40 lakh crore, employs 5 million people directly, contributes 8% to GDP. What the big players do matters a lot.
But hovering over all of this is the AI question, the automation fear.
It's impossible to ignore. McKinsey estimated AI could automate maybe 30% of coding jobs.
Yep.
That forces a massive shift.
Right.
Higher value work, consulting, complex problem solving, strategy, the routine stuff gets automated. So this buyback, it's not just about finance. It's happening against this backdrop of massive technological change. It's part of the bigger story of how Indian IT adapts or needs to adapt to thrive in an AI world.
Feels like a very disciplined move, in a way. Rewarding loyalty, signaling strength, playing the long game carefully.
I think that's a fair assessment. This is 18,000 crore buyback. It really showcases that dynamic interplay, doesn't it? Market forces, corporate strategy, investor feeling, it's all in there. And it comes from a company with a proven history of adaptation.
Yeah, that history is key. From that tiny startup to a global leader.
Yeah.
And like you said, they're focusing on AI. 40% of their deals apparently now involve generative AI. So the really interesting question now becomes, how do they balance this? giving back big sums to shareholders, which keeps them happy now, versus making those potentially aggressive strategic spends needed for the next phase of growth.
Like acquiring that cutting-edge AI startup or really pushing hard into Europe, maybe?
Exactly. Can they do both?
Mm.
Can they keep shareholders happy with returns and find that rapid growth mojo again through bold investment? That's the tightrope they're walking.
And it's a high-stakes tightrope in today's tech world, isn't it? Will this careful, balanced approach be enough to keep them at the forefront?
Yeah.
Or does playing it relatively safe, prioritizing immediate returns, potentially limit their ability to make truly revolutionary leaps later on?
A fascinating puzzle indeed.
It really is. Billions of dollars riding on getting that balance right.
So what really stands out to you after digging into all this, for me, it's just a reminder that the stock market isn't just numbers on a screen. It's strategy, it's psychology, it's, well, part theater sometimes. And as Infosys shares the wealth with this huge buyback, you just have to wonder, what's the next chapter in this constantly evolving tech story? What's the next big move?
Always another move around the corner.
Always. Well, we hope you enjoyed this deep dive into the Infosys buyback. Until next time, keep digging, keep learning, and stay curious.